Hey everyone, and welcome back for another deep dive.
Glad to be here.
Today we're tackling a topic that you've been looking into, building wealth with ETFs.
Yeah.
And specifically, we're diving into this YouTube video by Investing Simplified Professor G.
Oh,
And, I have to say, his approach to a modern 3 ETF portfolio really caught my attention.
interesting.
Yeah, he's all about that long-term, relatively hands-off approach to growth,
Right.
which I know is something you've been really focusing on.
Yeah, for sure.
But here's where it gets interesting. He claims that the traditional three-fund portfolio that we've all heard about, the U.S. stocks, international stocks, and bonds, is actually outdated.
Yeah, Professor G makes a compelling case for why that old model might not be the best fit for investors today.
Okay, so let's break that down.
Okay.
Why is this old model losing its relevance?
Well, think about how globalized the world has become these days.
Yeah,
Huge U.S. companies like Apple, Nike, Johnson & Johnson, they're dominant players everywhere.
right.
So when you buy an international stock ETF, you're often getting a lot of exposure to these same companies.
That makes sense.
So a separate international stock allocation might not be as crucial as it once was.
Okay, but what about bonds?
Yeah.
Aren't those supposed to be the safe part of the portfolio?
That's the common perception, yeah.
Yeah.
But bonds are actually yielding incredibly low returns these days,
Okay.
sometimes even lower than inflation.
Oh,
So the idea of bonds as a safe haven definitely needs a rethink.
I think a lot of people would be surprised to hear that.
Yeah.
So what's the alternative?
Well,
How does Professor G suggest we build this new 3 ETF portfolio?
he breaks it down into 3 key categories:
Okay.
a foundational ETF, a dividend ETF, and a growth ETF.
Okay, let's dive into each of those.
Sure.
What's the deal with this foundational ETF?
The foundational ETF is all about establishing a solid base for your portfolio.
Okay.
Just like, if you were building a house,
Yeah.
you need a strong foundation. Professor G recommends focusing on the S&P 500 for this,
Okay.
which is basically an index that tracks the performance of 500 of the largest U.S. companies.
Okay.
And you can invest in the S&P 500 easily through ETFs like VOO or VTI.
Okay.
These ETFs give you broad exposure to the U.S. market.
And speaking of the U.S. market, and I know that long-term hands-off growth is important to you. The S&P 500's historical performance is pretty compelling.
Yeah.
Because even during market dips, holding for 20 years has always yielded positive returns.
That's a powerful track record.
That's pretty amazing, right?
Yeah.
Okay, so we've got our foundation.
Mm-hmm.
What about this dividend ETF?
Yeah.
How does that fit into the mix?
This is where Professor G gets really interesting.
Okay.
He positions the dividend ETF as a replacement for bonds in the modern portfolio.
Interesting, because bonds aren't offering that safety anymore.
Exactly.
Okay.
Dividend ETFs focus on companies that pay out consistent dividends to their shareholders.
Okay.
It's like getting a regular paycheck from your investments.
Oh, that's nice. Yeah.
So it's still about safety and stability, but with the potential for much better returns than bonds.
Exactly.
Got it.
Professor G compared a popular bond ETF, BND, which returned a measly 1.6% over the last 10 years, to SCHD, a dividend ETF, which yielded a whopping 11.5% over the same period.
That's a huge difference.
Huge difference.
Instead of tiny bond returns, you could potentially be seeing significant growth and getting regular dividend payouts.
Exactly.
Wow.
And to really drive the point home, Professor G uses a $50,000 investment example.
Okay.
After a decade in that bond ETF, you'd only have about $58,000.
Okay.
But with the dividend ETF, you could potentially be looking at $150,000.
Okay. I'm starting to see why he's ditching bonds in this model. But are these dividend ETFs risky?
That's the beauty of it.
Okay.
SCHD, for example, holds well-established household names
Okay.
like Broadcom, Home Depot, Chevron, Coca-Cola.
Yeah.
Companies known for their stability and consistent performance.
So not the flashy high-risk stocks that keep you up at night.
Not at all. Okay, good.
These are companies that are deeply ingrained in our economy and tend to weather market storms pretty well.
Makes sense.
Plus, SCHD itself is diversified across various sectors: industrials, financials, healthcare, and more.
So it's like a safety net within a safety net.
Exactly.
Okay, that makes me feel a lot better.
Good.
So we've got our solid foundation, we've got our steady dividend income.
Right.
What about the excitement?
Okay.
Where's the growth potential in this portfolio?
That's where the growth ETF comes in.
Okay.
This is where Professor G taps into the power of innovative, tech-focused companies that are really driving the future.
Interesting.
He sees this as a more relevant play than a broad international stock allocation.
So instead of going global, we're going for growth.
Precisely.
Okay.
And again, the numbers back it up.
Okay.
While an international ETF like VXUS has averaged about 4.6% returns over the last 10 years, a growth ETF like QQQM has delivered an average of 18.36% annually over the same period.
Wow.
Pretty significant difference in potential growth.
Those numbers are hard to ignore. So what kind of companies make up a growth ETF like QQQM?
You'll find names like Microsoft, Apple, Nvidia, Amazon, Meta, Tesla, Google.
Oh, the big ones?
The companies that are at the forefront of technological innovation and have a proven track record of success.
It sounds like Professor G is really emphasizing sustainable growth, not just chasing the latest fads.
Exactly. He specifically cautions against jumping on the AI and semiconductor bandwagon, even though they're incredibly popular right now.
Yeah.
He believes in investing in companies with a history of innovation and a clear path forward.
I see. So it's more about looking at those long-term trends,
Yeah,
not just what's hot today.
exactly.
That makes sense. And I have to say, QQQM's low fees are a huge bonus.
Yeah, keeping fees low is absolutely crucial for maximizing returns over the long term.
Absolutely.
He's definitely done his homework.
So it seems like he's done his research to find ETFs that are both high-performing and cost-effective.
Right.
Okay, so we've covered the three main components of Professor G's new 3 ETF portfolio: foundational, dividend, and growth. But how does all this translate into a personalized strategy?
That's a great question.
What about my individual goals and risk tolerance?
That's the next key piece of the puzzle, and it's something we'll dive into further. But before we do, let me ask you this.
Thinking about your own time horizon, say 10, 20, even 30 years from now.
Yeah.
How does the idea of weighting your portfolio towards growth or dividends resonate with your goals?
That's a great question to consider. And, Professor G, at 35 years old, he opts for a simple equal weighting across all three ETFs.
Okay.
1/3 foundational, 1/3 dividend, and 1/3 growth.
Okay.
He's got a long time horizon, so he's comfortable with that level of growth exposure.
Right. And he really hammered home the idea of consistency no matter what the market is doing. He just keeps investing a set amount at regular intervals.
He's a big believer in dollar cost averaging,
Yeah.
which essentially means you're buying more shares when prices are low and fewer shares when prices are high.
Right.
It's a way to take the emotion out of investing and ride out those market ups and downs.
It sounds like a strategy for someone who wants to build wealth steadily over time without constantly checking their portfolio and stressing about every market dip.
Exactly. Professor G's philosophy is all about long-term growth and letting compound interest work its magic.
Yeah.
It's like planting a seed and letting it grow. You don't dig it up every day to see if it's sprouted.
That's a great analogy.
You give it time, you nurture it, and you trust the process.
But even with this hands-off approach, Professor G admits there are times you might consider selling.
Right.
He didn't really dive into that in the video, did he?
He didn't go into specifics, no, but he did touch on the concept of rebalancing.
Okay.
Over time, as certain investments perform better than others,
Yeah.
your initial asset allocation can get out of whack.
So like if your growth stocks take off and suddenly make up 50% of your portfolio instead of the 33% you started with.
Exactly. That's when rebalancing comes in. You'd sell a portion of your growth holdings and redistribute those funds to your foundational and dividend ETFs to bring things back into alignment with your target percentages. So it's not necessarily about trying to time the market or predict which investments will do better. It's about maintaining a consistent strategy and adjusting as needed.
Precisely. It's about making sure your portfolio stays aligned with your risk tolerance and overall investment goals. Now, Professor G focused mainly on financial factors, but I think it's important to mention another reason you might consider selling.
Oh, okay. What's that?
Sometimes it comes down to values. Let's say you're invested in a company that you later find out is engaged in practices that go against your personal ethics.
You mean like environmental damage or questionable labor practices?
Exactly. Some people might choose to divest from that company even if it's performing well financially, simply because they no longer want to support it.
That makes sense. Aligning your investments with your values is important too.
Yeah.
Okay, so we've talked about rebalancing and values-based selling, but is there ever a time to sell purely based on market conditions? Like, if you think a recession is looming, should you pull your money out of the market?
That's a tricky question, and honestly one that even seasoned investors grapple with.
Yeah. Trying to time the market is notoriously difficult, and often it does more harm than good.
Yeah, because you could miss out on the rebound.
Exactly. Remember how we talked about the long game?
Right.
Professor G's strategy is built on the idea that the market over time trends upward.
Yeah.
There will be dips and corrections along the way, but trying to predict those perfectly is nearly impossible.
So ride out the storm, stick with your plan, and let the power of compound interest do its thing.
That sounds like a less stressful way to approach investing, for sure.
Right.
But it does require a certain amount of trust in the market, doesn't it?
It does, and that's where doing your research and understanding your investments becomes crucial.
So don't just blindly follow someone else's advice, even Professor G's.
Right.
Dig deeper. Understand the why behind the strategy and make sure it aligns with your goals and your comfort level.
Absolutely. And that's where resources like books, articles, and yes, even podcasts like this one can be incredibly helpful.
Yeah.
It's about staying informed and continuing to learn. Speaking of learning, Professor G mentioned in his video that he has other videos that go into more detail on age-based portfolio options.
Right.
We'll definitely link to those in the description for anyone who wants to explore further.
That's a great resource. It's fascinating how your investment strategy can and should evolve as you move through different stages of life.
Absolutely. It's not a one-size-fits-all approach. Yeah. So as we wrap up this part of our deep dive, what are some key takeaways you'd like our listener to walk away with?
I think the most important takeaway is that building wealth through ETFs can be surprisingly straightforward.
Yeah.
Professor G's 3 ETF portfolio is a great example of that. It's simple, it's effective, and it's designed for long-term growth.
And even within this simplified approach, there's room for personalization. You can adjust the weighting of the ETFs based on your risk tolerance and time horizon.
Exactly. And remember, investing is a journey, not a destination.
Right.
It's about making informed decisions, staying disciplined, and letting time and compound interest work their magic.
But before we move on, there's one last thought I want to leave our listener with. We've talked a lot about the how of investing with Professor G's strategy, but I think it's equally important to consider the why. Professor G's approach is all about building long-term wealth.
Right.
But what does that wealth ultimately enable you to do?
That's a good question.
What are you hoping to achieve with it?
Investing shouldn't just be about accumulating money for the sake of it.
Right.
It should be about aligning your finances with your purpose.
So it's about figuring out your why.
Exactly.
What are you working towards? Is it financial freedom, early retirement, funding a dream project?
Exactly. Maybe it's about having the security to pursue your passions or travel the world,
Yeah.
or simply spend more time with loved ones.
Yeah.
Whatever your why may be, let it be your guiding star.
It makes investing feel so much more meaningful when you connect it to your values and aspirations.
Sure.
It's not just about numbers on a screen.
Right.
It's about building a life you love.
Absolutely. And when you have that clarity of purpose, it becomes easier to stay committed to that long game.
Yeah.
You're not just chasing returns.
Right.
You're building a future that resonates with your deepest desires.
That's so powerful.
Yeah.
It's about taking control of your finances and using them as a tool to create the life you envision.
I couldn't have said it better myself.
Okay.
And, Professor G's simplified approach with these 3 ETFs can really help streamline that journey.
Yeah.
It takes the guesswork out of stock picking and market timing.
That simplicity seems to be a major draw for a lot of people.
Right.
It frees up time and mental energy to focus on other things that are important to you.
Exactly. It allows you to prioritize your passions, your relationships, your overall well-being.
Right.
And that in itself is a valuable return on investment.
I love that perspective. So as we wrap up this deep dive, let me leave you with one final question to ponder.
Okay.
Professor G advocates for a buy and hold approach with these ETFs.
Yeah.
But is there ever a time to sell?
That's a fantastic question, and it gets to the heart of the long-term investing philosophy. While Professor G emphasizes minimizing trading activity, there are a few scenarios where selling a portion of your holdings might make sense.
Okay, so it's not a never sell ever situation.
Right. Think of it this way. Your life is constantly evolving, right?
Mm-hmm.
Your goals, your circumstances, even your risk tolerance might shift over time.
Yeah.
Your portfolio should reflect those changes.
So, for example, if someone is nearing retirement,
Yeah,
they might want to adjust their portfolio to be a bit more conservative.
exactly. They might choose to sell some other growth ETFs and allocate those funds to more stable options like dividend ETFs or bonds.
Okay,
It's all about aligning your investment strategy with your current life stage and financial needs.
that makes a lot of sense. It's about staying adaptable. What are some other situations where selling might be warranted?
Well, sometimes it comes down to those values we talked about earlier. If a company you're invested in starts engaging in practices that you find unethical or harmful, you might decide to divest, even if it means taking a financial hit.
Yeah, putting your money where your values are.
Exactly.
I like that.
And finally, there's the concept of rebalancing, which we touched on earlier. Over time, your portfolio can drift away from your target allocation.
Right.
Due to market fluctuations, you might need to sell a portion of your outperforming holdings to bring things back into balance.
So even with a buy and hold strategy, there's still an element of active management involved.
Right. It's not a set it and forget it approach entirely,
Okay.
but the key is to rebalance strategically,
Yeah.
not in reaction to short-term market swings. Avoid those emotional decisions driven by fear or greed.
So stay informed, stay aligned with your goals, and be prepared to make adjustments as needed. But don't panic and sell everything when the market dips.
Exactly. Remember, the power of long-term thinking. Professor G's 3 ETF portfolio is designed to weather those storms and come out stronger on the other side.
Well, I think we've covered a lot of ground today.
Yeah.
From debunking old investing myths to exploring the nuances of a modern ETF portfolio.
Right.
And most importantly, we've connected it all back to the listeners. Why the driving force behind their financial journey.
It's been a fantastic discussion.
It has been.
I hope our listener is feeling empowered and inspired to take control of their financial future.
Me too. Remember, building wealth is a journey, not a race. So stay curious, stay informed, and keep diving deep.
Keep diving.
Until next time, happy investing.